Hi, welcome back. And this is chapter 6. We're going to be talking about credit cards today. So we have a few learning goals here. One, basically I want to explain to you how credit cards work, what's the cost of using credit cards, the different type of cards, what determines your credit score, credit worthiness, how to manage your credit cards. So let's just start at the beginning. So part of being a financial adult is having credit cards. Now, credit cards are something to be careful of. They are basically a tool for banks to make money. So they will make money by charging you as well as the merchants where you buy your goods and services from. So if you use credit cards smartly, you won't pay too much. But if you use them in a very financial irresponsible way, it could cost you a huge amount of money in many areas, even outside of credit cards. And what I mean by that is if you accrue a large credit card debt and you don't pay it, then this will affect your credit score, which will affect the rate of interest you'd pay on a car loan or a mortgage. And also the credit history is used in renting an apartment and possibly in getting a job. So you got to be very careful with how you use credit cards, and you never want to um, accumulate such a balance on credit cards where you can't pay them off and become insolvent. Now, most credit cards are going to charge anywhere between, say, 12 to 25% interest. And this interest is on the portion of your balance that is unpaid or rolled over to the next month. And starting out, when you're just starting out getting credit cards, you will most likely be in the higher interest rate categories. So you need to consider the interest rate when you make a purchase. So if you make a purchase and say you buy $1,000 computer and it takes you a year to pay off the computer, you're paying a lot more for that computer than you may originally budgeted for because of this interest. So you want to avoid at all costs paying high interest on your credit cards. Now, the credit cards are basically a revolving credit. So with credit, you could receive just credit in general, whether it's credit cards or loans. You can receive money to buy things. Now, with credit cards, they're a special type of, think of them like a loan. You can receive cash with your credit card, you can buy goods and services, and you just have an obligation to pay back what you borrowed at a later date. Now, if you have a open credit, a revolving credit, this is a line of credit that extends before the purchase. So any unpaid balances on this credit are going to carry over to the next month with interest, and higher balances on credit lines mean even higher rates of interest sometimes. So you have to be careful of how you utilize your credit cards. Now, your credit card is sort of a open revolving credit where you're given a credit amount, maybe $10,000, that you can spend up to. Um, and even then, if you do reach your credit maximum or limit on your card, you can request that to be extended. Now, the downside of these credit cards is the interest rates. So a lot of times what they'll average, what you actually pay and what the annual percentage rate or the APR could be different because you want to look at the effective annual rate. Now, the the annual rate, say if it was 12%, so basically you would be paying each month 1% on your total outstanding balance. And if you held that balance for a full year, you'd be, up to the 12%. Um, Now, all the interest rates that a credit card would charge you must be disclosed. When you get a credit card, it'll come with a rather lengthy booklet explaining all of the terms and conditions and all the rates, um, and whether or not your credit card is a fixed APR or a variable APR. Some credit cards may start out with a teaser rate, which could be 0% interest for the first 6 months, or 1% interest for the first 6 months, then going up to 15% interest after that. And some cards may have a variable rate, and the rate will change along with interest rates in the economy. Now, the compound interest in this case is not your friend. Compound interest or compounding is your friend when you're saving, but when you're borrowing, this compound interest, which means paying interest on your interest, is not your friend. It basically means you're going to be paying, the longer you wait to pay off your credit card balances, the more interest you'll accrue and the more interest you'll pay on that interest. Now, how do you calculate the balance owed? So the method of determining the balance, there are your average daily balance method, that's one way, the previous balance method, and the adjusted balance method. So let me just go back here. So there are a few different ways where the credit card company can determine what the balance is. So let me just talk about these a little bit more in depth. So the average daily balance, this is your average daily balance, and it's calculated by adding up your daily balance during the billing period, which is usually a month, and dividing it by the number of billing days in the month. So maybe 30. So interest payments are based on this balance. So, and this is used by 95% of all bank issued credit cards. So very popular bank issued credit cards. So why this? I don't like this method because what if you put a large purchase on your card, maybe $20,000 purchase, and then you pay that purchase quickly. It still raises your average daily balance, and if you don't pay off that total balance in time, that could be a lot of interest, even though um, it was only one purchase for a couple of days. Previous balance method. So this is interest payments are going to be charged against what you owe at the end of a previous billing period. Um, so there is no credit given for the current month's payments. So the method is relatively simple, but it is also the more expensive method. This is the method I think some of my cards go with, where they look at the previous month's balance. So in the new month, you pay interest on your previous month's balance at the end of the period. Now the adjusted balance method, this is interest is charged against the previous month's balance only after any payments have been subtracted. So because interest isn't charged on the payments, this method results in lower interest charges than the previous balance method. Now, so you can see that this is why I have to read the fine print of your credit card, which is how are they determining the balance of your account to calculate interest. This is why, I mean, I have a number of credit cards. I'm not sure which credit cards are using which balancing method, but I subscribe to paying off all my credit cards in full at the end of the month so as not to accrue any interest. And you can do a automatic payment on your credit cards, and you can select a fixed amount, a minimum amount, or and most credit cards will give the ability to say pay off the balance, and that's usually what you should do, is pay off the balance automatically every month so you're never caught paying any type of interest. Now here's an example of these methods. So if we look at this particular slide here, so say your credit card interest rate is 18%, and you begin the month with a previous balance of $1,000. In addition, your payments against your credit card balance this month are $900, which are made in the 15th of the month. You make no additional purchases for the month. So let's look at, if we look here on the screen. Um, Now, if this is hard to see, there's a copy of this figure in the textbook as well. So here's your monthly rate. This is taking the 18, dividing by 12. So the monthly rate is going to be 1.5%. The sum of your daily balances here is during the billing period is 16.5. 30 days in the billing period, average daily balance is 550. So it's the 1650 divided by 30. The interest charge is going to be 8.25%. Which is the 550 times 1.5%. Now, if we use the previous balance, so if the previous balance was the previous balance was 1,000, and then you make payments of 900, the interest charge is going to be 15 because it ignores the payments and is going to take 1.5% of the $1,000, which is the previous balance. On the adjusted balance method, it's going to look at, and this is probably the best method to have, it results in the lowest amount of interest. You get your still at 1.5 monthly rate that you're going to pay. The previous balance of 1,000, it subtracts your payments of 900, so you're only going to pay interest on the $100. So you can see how this is the best method, is most favorable. So this is something that you could ask your credit card company, how do they calculate the balance? Is it daily balance, previous, or adjusted? Most of the times the customer service rep will be, oh, I don't know, they won't know how to answer this. I have to move you over to a specialist, and then, they'll be able to confirm this. Now let's talk about, say you need some cash, and you need a cash advance. So this is probably the most expensive thing you could do with your credit card, and something I would always advise against. If you need cash, this is something you should use your debit card for. Don't use your credit card to get a cash advance. Even though you can use your credit card ATMs to get a cash advance, there's going to be a separate interest rate, a higher interest rate, charged immediately on the cash advances. So there's usually an upfront fee of 2 to 4% of the advanced amount. So to pay down the balance for the purchase, so if you want to pay down your balances, your purchases are going to be paid down first, and then the higher rate cash balance would be paid down after their purchases. So it's something that they use these cash advances in a way to make themselves a terrific amount of money for the bank. So you never want to do these cash advances because you're just going to be paying exorbitant interest rates on the cash advance. They make it harder to pay off the cash advance because most cases you must pay your purchases before you pay down your cash advance, and they charge you these upfront fees. So my suggestion is never take a cash advance on your credit card. Use your debit card or go to the bank directly, or use a teller directly at the bank if you don't have a debit card. But I would suggest before you get a credit card, you have a bank account, a checking account, a savings account, and you have a debit card, and then you want to entertain getting a credit card. Now, let's talk about the grace period. So lenders will give you a grace period, which is a specific length of time before any interest is going to be charged on your account. It's not a month. A lot of people think it's a month, but the credit card companies have shortened this window, this grace period window, in some cases as low as 21 days, but most cards are between 21 to 25 days from the date of the bill. So some credit card companies can actually have no grace periods. This is something else you want to find out. What is the grace period? Now, a no grace period is always in effect with cash advances. That's why you don't want to do the cash advance. Now, for most cards, the grace period is canceled if there is unpaid balances from the previous month. So if you have an unpaid balance from the previous month, that rolls over and starts getting charged interest day one. It's only your new purchases that will fall under the grace period. So as a result of the grace period, the finance charges, may not be assessed against your credit card purchases for, extended period of time. So this is just something that you want to figure out. How long does it take before you start paying interest on your purchases? And it is a confusing aspect with this grace period with most credit cards. That's why I always suggest, if you don't understand your grace period and you don't want to spend the effort to understand your grace period, just pay your balance off in full at the end of the month, and that way you'll never have to pay any interest. Okay, annual fee. Now, when you first start building your credit cards, say you don't have any credit cards right now, some of the easier credit cards to get would be a credit card that has an annual fee, because that reduces the risk to the credit card company when there's an annual fee, because it's sort of a built-in profit. And usually more specific credit cards like a Delta Airlines, Southwest Airlines, they'll have an annual fee, usually less than $100. These cards are typically easier to qualify for than some cards that have no annual fee. Um, Now, most other credit cards, and this is saying 70% of the biggest credit card issuers, do not charge an annual fee because most investors are turned off by the annual fee. However, cards that do charge an annual fee usually try to return something to you in say points. So if you get a Delta or Southwest credit card, you will get an introductory points offer, which, say for example, it's not uncommon to get um, 50,000 points when you sign up to Southwest, which is about $750 worth of travel credit. So this helps to offset this annual fee. Other cards may give you other allowances, and I think some of the Southwest cards will give you 2 free early bird access, which is I think $25 per flight, which means you just get to line up and board early. Uh, Delta will give you a first bag will be checked for free. They might give you discounts on in-flight purchases. So there are other benefits to the cards that have annual fees. Now there are some big travel cards with annual fees that range in the hundreds of dollars, $500, $600, $700, and these um, branded, more platinum type of cards would give you even bigger discounts on travel and even bigger onboarding rewards. Now, the annual fee is usually charged at one time per year. So typically when you do get a card with an annual fee, most cases you'll pay the annual fee within the first 60 days of the card, and then a year again within a year. So the most consumers don't, I would say, stay away from cards with annual fees. I'd say you would only consider a card with an annual fee is if you can justify the benefits of the card outweighing the actual annual fee. And we'll talk more about that later. Um, but it's a good question to ask if a card has an annual fee. So some additional fees that um, you might want to think about. One thing that I did mention is the merchant's discount fee, and this is a credit. Um, so what this basically is a fee to the merchant. So if um, you purchase something on your credit card, the merchant's going to pay a percentage of the sale as a fee to the credit card that you charged with. Um, so, for example, if you buy $1,000 TV, there could be $30 that the merchant has to pay as a fee to the credit card company that you're using to buy the TV with, and that's why some merchants will actually they can actually charge a premium if you use a credit card to help make up for this additional fee that they pay when you use your credit card. But these discount fees that the merchant credit card uses is how they fund rewards points and things like that on cards. Um, so say, for example, some cards might give you a 2% cash back. In that case, when you're using the card, the merchant's paying 3% to the credit card company. The credit card company is keeping the 1%, but then giving you 2% cash back at the year end. And that's, a big way of how they fund um, all these rewards on these credit cards. However, merchants don't like it because they're basically going to get less profit per item that you buy with a credit card. So typically a big place where you'll see this is when you go to a gas station, there'll be a cash price and a credit price. And the credit price is higher to make up for the fact that they have to pay this merchant fee. Okay, now let's move on here to some additional fees. So this is how the credit card companies make money, is they have fees. So there's also the cash advance fee, and this could be just a straight up fixed amount, $5, $10, $20 fee every time you want to take a cash advance. There's a late fee, which, if you pay your credit card, if you don't pay your credit card on time, there can be a fee of around $25 for paying your credit card late. That's why you always want to set up that automatic minimum payment. At the very least, I would say set up automatic full payment, but if you don't want to do the full payment, you just do a minimum payment. That way you're guaranteed never to have to pay a late fee. There's an over the limit fee, and this is when you charge more than your credit limit allows. And it's kind of, they should really decline your card if you reach your credit limit, but they don't. They let you reach your credit limit, go over it, then charge you a fee every time you buy something above your credit limit. And they hope that you go around and do 10 purchases that day because they could charge you 10 times over the fee limit. Now, there's also a penalty rate. So the interest rate you pay, that's if you're a good credit user. But if you have a period where you're late, then they may change your interest rate. So you could be paying a 12% interest rate, and then one time you miss a payment, and they automatically jack up your fee, your interest charges for the rest of the year to 22% as a penalty, and that will be a penalty rate. Now, there was a point where during the Obama administration, they changed this. They created a law to prevent what was called universal default. So if you didn't pay one of your credit cards, you defaulted on one of your credit cards, meaning that you didn't pay them on time, not only could that credit card company raise your rate, but all the credit card companies would get notice that you defaulted on one of your cards, and all these separate companies would raise your rates on all your credit cards. And this is really punitive, and this was made illegal to do. But it was one of the sneaky and tricky things that credit card companies did to get more money from you. Okay, but credit cards are not all bad. There are many advantages to credit cards, and I believe everybody should have a credit card as long as you treat them with respect and charge them responsibly. Now, what's great about a credit card is that if you are able to put most of your financial transactions on a credit card that has where you earn cash back or rewards, say you just have a credit card that earns a 2% cash back. Well, this could be a significant amount of money. So if you spend, $10,000 a year on your credit card, which isn't unheard of, you put all your purchases, your gas, your food, tuition on the credit card, you may reach 10,000 or even 20,000. You could be sitting with a $200 to $400 cash back reward. In other cases, you can get rewards as far as points for travel and other such points, depending on what the associations the card has with other companies. In addition to helping build your credit and build your credit score, credit cards are a good piece of your credit score puzzle to help build your credit score. But let's just talk about some more obvious advantages. One is convenience. It's much more convenient to carry a credit card around and charge all your purchases to the credit card than have to manage cash and deal with change and replenishing your cash. It's very convenient. It could be used as a source of identification. It can also, if you have a Costco account, you can get a Costco credit card, which I think is a City Visa right now. And the City Visa will also have your picture on it and act as a form of your membership ID for the Costco Wholesalers Club, as well as giving you additional 2% off. So theoretically at Costco, if you have the executive membership, you'll get 2% off your purchases, and then if you have the City Costco credit card on top of it, you get another 2% off your purchases. So that's a total of 4% off all your purchases at Costco, which is a good deal if you spend a lot of money at Costco. Now, it's also important to have a credit card to make any type of phone or internet purchases. You can't purchase things over the phone or on the internet easily without a credit card. So it's probably the most secure, best way to purchase things. There are other ways you could do it, of course, but the credit card's probably the easiest way of doing it. A credit card is good for temporary funds. You're in between paychecks, or you just don't have um, a large amount of money needed to purchase for something. Say it's going to pay your monthly tuition, and you don't have, $4,000 for that. You put it on your credit card, then you have time to pay it off um, over a set number of months where you can catch up with it as you're working. Um, you could use the product before actually paying for it. So in some cases, you buy the product, try it out, doesn't work, doesn't fit, you can return it, and then it comes off your credit card before you're even, have a monthly statement and have to pay for it. So it does kind of extend the period until when the money actually leaves your account to pay for the product. Um, it's a good way to consolidate your bills. So for my credit cards, I typically will sign up at, the phone bill, the electric bill, the cable bill, the water bill. I will use the credit card to pay for all these bills. So then all the bills come to one account, and it's just very easy to keep track of. Plus, I earn points on spending in all these bills. The Now, it's if you use, where when interest rates are going up now, if you have a significant amount of interest on your money market or savings account, this would be a way to pay nothing today, have the money sitting in your bank earning interest, and then when you pay off the credit card in, 30 days or so after the grace period, you would get an extra couple of weeks of interest. Really usually doesn't amount to much though. Now, credit cards usually do come with, depending on the credit card you get, a lot of credit cards add some additional features to make their credit card a little bit more competitive. And the merchant fee we talked about earlier helps pay for these extra features, such as extended warranties on your purchases, such as travel insurance and other rewards. Now, a lot of times, they'll give you rental car insurance. But I think a lot of people get confused when you have a credit card that has rental car insurance. You typically still have to go through your primary insurance first before the credit card rental car insurance will do anything. So you need to double check some of these extra warranties and insurance that the credit cards offer to understand how do they work and when can you use them. A lot of times they 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 advertise them or promote them in a misleading way to think they're more valuable or more protective than they actually are. Now, to get to some of the drawbacks or disadvantages of credit cards, a big one is it can form a disconnect between um, the money you have and how you spend it. So if you have cash in the bank and you withdraw cash and you have cash in your hand and you spend your cash, you might be a little bit more conservative on your spending. You might say, okay, ooh, look, a $500 TV, but I only have $100 of cash on me, and I only have, so much money in the bank. I really don't want to spend that money right now. But when you have a credit card, it makes it far too easy to buy those big purchases because cash isn't leaving your hand, which is, for some people, there's like a gravity to the cash. You want to keep it in your hands. You want to keep it in your bank account. So the credit card makes a disassociation between your cash and what you're spending. It's very easy to lose track of your spending, especially if you're putting everything on your credit card, your gas, every purchase. Anytime you spend any money, you're putting that on your credit card, and you're not seeing the direct connection between your bank account go down or the cash in your pocket go down when you're spending this money. Now, just because it makes it easy to spend money or makes it easy to lose track of your spending doesn't mean that has to happen to you. If you keep a budget, if you keep even a mental budget in your head, just or even a loose notebook, just to kind of write down your spending, um, you can prevent yourself from losing track of your spending or spending too much money. Simply just saving your receipts and putting your receipts in the receipts calendar. So that way it could just be a regular calendar. You just tape your receipts on the day that you buy whatever you're buying. This gives you a better visual of what you're spending. Now, the biggest disadvantage is these extraordinarily high interest rates on credit cards and cash advances. That's why I always say if you can't afford to pay for it within the month, you shouldn't buy it. So it's better off to save up the money until you have enough money to buy what you want to buy, and then put it in your credit card and pay it off at the end of the month, so you don't have to pay such a high rate of interest. And this is what usually when credit cards get out of control, is when people start having, you know, 5, 10, 15, $20,000 balances, and then when 20% interest kicks in on that, that could be you have a $20,000 credit card balance, and then you're paying $4,000 a year in interest on top of that. So this is what can really make your spending spiral out of control. Now, the other disadvantage is if you overspend, you're going to start borrowing from the future, or depending on future revenue, future income to pay for your present purchases. So this can cause these budgetary problems of this, it makes it too easy, too attractive to spend money. So you got to really be careful and have more of a mental fix on your spending, and don't let the credit card seduce you into buying things um, that you really don't need, or buying something in a more expensive version of something where a less expensive version could do. Now let's look at a lot of people listening to this are undergraduates, so let's look at the undergraduates and payment behavior. Okay, so 7% will make, and this is just, I'm not actually sure where they're getting the statistics for this, but let's just go with it and just say it's accurate. So 7% up here, this purple wedge, 7% make less than the minimum payments on some of the credit cards each month. And then 1%, the parent, spouse, or other family members pays the credit card bill. So that'd be nice to be in this 1% where your parent pays the credit card bill. 17% will pay off the credit card balances at the end of each month. So this is a good bracket to be in. 22% will make a minimum monthly payment on all credit cards every month. 14% will pay off credit cards in full each month, but make only minimum payments on other credit cards. And 38% make more than minimum payment, but always carry some sort of balance. So this is sort of how the spending. So you want to be in this purple wedge, this maroon reddish wedge up here, where you pay off all your credit card balances in full each month, if you can. Sometimes it's just not always possible, but this would eliminate you paying any interest. Now I was talking about Obama before, and he, during his uh, presidency, is what I'm looking for, there was a financial crisis, a big financial crisis that happened at the end of George W. Bush's presidency, and Obama inherited. And then one of the outcomes was that he saw how predatory credit cards were getting, and how many people were becoming bankrupt from the policies of credit card companies. So his administration helped create and pass this Credit Card Accounting Responsibility and Disclosure Act, as an acronym we call it CARD. So the CARD Act, has a number of, as you can see here, there's 11 things we're going to go over here. It has a number of things, and how it's going to affect you as a credit card user. So now, number one, they have to notify you if there's going to be a rate increase in your credit card, and they have to notify you 45 days before this planned rate increase on your credit card, which before they could just raise your interest rate at any time. So they have to notify you if they're going to increase, the credit card company is going to increase your credit rate. If they're going to change certain fees, like annual fees or cash advance fees or late fees, make any significant changes to the term of your credit card. But the company does not have to notify you if you have a variable rate interest on your credit card, which you don't want that. You don't want a variable rate interest. They don't have to notify you if your introductory rate expires and reverts to the standard rate, or if your rate increases because you haven't made your payments. So this is what was determined in this CARD Act. Number two, a notification of schedule of payoff. So now it used to be they set the minimum payments so low, It was designed that if you paid the minimum payments, you'd never pay off your credit card. But through the Card Act, the credit card companies have to tell you how long it's going to take to pay off your balance and how much you'll need to pay each month in order to pay off your balance in 3 years. And this has to appear on your statement, making it much clearer to credit card users, how long it would take to pay off the credit card debt. And they also have to raise the minimum um, balances that you would pay each month uh, in order to really calculate these scheduled payoffs. Okay, number 3, no interest rate increases for the first year. So credit card companies cannot raise your interest rate for the first 12 months after your open account, unless it's a variable rate account or unless there is an introductory rate, like a 0% interest rate, um, or you take more than 60 days to pay your late bill. So other than that, you'd be pretty good. Number 4, increased rates apply only to new charges. So if you have a $40,000 credit card balance and they increase your interest rates, it's only going to be in the new purchases, not the purchases that make up the $40,000 from previous years. And that's an important distinction because in the past, when they did this universal default and you had $10,000 on your credit card and they moved you from 12% interest to 24% interest, that would be a significant amount of additional interest you would owe. Very unfair. They there's restrictions on over the limit transactions, so they can't just let you continuously have your card being charged over the limit and hitting you with additional fees every time. There are caps on high fee cards, so high fee cards cannot total more than 25% of the initial credit limit for fees. Protections for underage consumers, so now they actually set more firm age limits on credit cards. So typically, if you're, it's very difficult to get a credit card if you're under 21 years of age by yourself. In the past, I think I got my first credit card at 18, which is something that's not so easily done today unless a parent co-signs. Uh, there was a time even when it was difficult for women to get credit cards unless their husband co-signed or their father co-signed with the credit card, no matter the age of the woman. So this, you could see how these credit card companies are outrageous in their unfair treatment to customers. Now, um, number 8, standard payment dates and times. So they standardize the payment dates and times so it's more obvious and more consistent. Payments directly to the highest interest balances first. So they no longer, what they used to do is just have you pay off what was, say you had a cash advance. Actually, they could still do that with cash advance. But if they had a new new rate applied, say they moved the rate up from 12 to 14%, and then you made a payment, they would try to apply it to the lower interest rate portion, not the higher interest rate portion, in effect making you pay more interest. So now interest payments have to directly go to whatever portion of the balance is the highest in interest terms, which is good. Um, Fee limits, so your credit card company cannot charge you a fee more than $25 unless one of your 6 payments was late, on your last 6 payments was late, in which case the fee may go up to $35, or it can show that the cost resulting from the late payment justifies a higher fee. And 11, no inactivity fees. So this is something where if you didn't use your credit card, they would charge you a penalty for not using your credit card. And this is something that they changed with this law. Recently, though, I have a very old Kohl's charge card. I don't know how I even got that, but I didn't use it for a number of years, and they sent me a letter saying they can't charge me an inactivity fee, but what they did, which was sneaky, they said, oh, if you don't make a purchase using your credit card, we're going to discontinue your credit card. And I didn't want them to discontinue my credit card because that's an old account. I've had it for a long, long time. And if they discontinue a credit card that's old, um, it changes the math on the average age of your accounts, outstanding accounts, which is a big factor in your credit card, your credit score. So your credit score is, if you get a credit card, whatever credit card you get, the longer you hold on to it, the better your credit card score is. So you don't want to be getting credit cards, canceling credit cards, and getting new credit cards, although it might be attractive because of sign-on bonuses. This will also affect your credit card score. All right, so let's talk about choosing uh, a source of open credit. So you have bank credit cards, which is credit cards issued by a bank that generally are going to work through Visa or Mastercard. So Visa and Mastercard and American Express and Discover, these are kind of payment networks. Well, Discover is actually the one card that's a little bit different because that was created later. But Visa and MasterCard are these electronic payment methods that the bank will utilize to create the credit card. So it will be branded as a bank card, but it still will have to use either Visa or MasterCard, or in some cases American Express, to facilitate the transactions with the merchants. Now, there are a lot of variations. You can get a premium or prestige card, an affinity card, a secured credit card. So there are um, these different types of credit cards. They all seem similar on the surface, but there are small differences behind these credit cards. Now, okay, so let's just talk about Visa and MasterCard for a second. So Visa and MasterCard, they're going to provide the electronic credit authorization system that banks are going to utilize. So they work together with banks, but they're two separate companies. In fact, you can get stock in Visa because it's not a bank, it's a credit card processing company. Um, Now, rounding out Visa and MasterCard is also American Express and Discover is sort of the big four of these processing accounts. Now, when we're talking about variations on different classes of credit cards, they, depending on your credit history, your credit score, your income, you can qualify for different types of class of credit cards. So sort of like the entry level, the experience level, the high end level. Um, Now, as a low end standard credit card, the limits are typically between 500 to 3,000. Then once you have some experience, like with an entry level credit card, and you do good paying off your balance and charge using the card and paying the card off regularly, then you can start moving into more of a gold class of cards, like a gold Visa or a gold American Express. And this is usually 5,000 to maybe $20,000 worth of credit card, and can provide extra perks and incentives such as credit rewards. And then if you do well with these cards and you start making more income, you can qualify for a premium or prestige card, which are for much higher credit limits beyond the standard credit card, and include many additional travel services, insurance, and rewards above and beyond the regular entry level credit cards. And a lot of times these premium credit cards will also have higher annual fees. Now, another variation of a bank card could be an affinity card, which is a credit card issued in conjunction with a charity or organization. So that way, this charity or organization will get a small benefit for every time you use the credit card. And you'll have the logo of the non-for-profit on the credit card as well. So you sort of have sort of like you'll be part of the generating revenue for these charitable organizations. Um, Now, these affinity cards are expensive, and the annual fees and some of the merchant uh, fees will go to the charity. You just got to really read the fine print of how that's, what percentage the charity is going to get, how much is the bank going to get, how much extra you have to pay for these affinity cards. I generally don't recommend affinity cards. I would say it'd be better to directly contribute to one of these organizations and be able to write it off in your taxes as a tax deduction for your charity money rather than using an affinity card. Um, there's also a secured credit card, and these are secured by a bank, usually pledging some sort of collateral like your savings or checking account. And if you can't pay for what you charge, then the bank will be able to take money out of your collateral and pay your credit card. And so it could be linked to some other asset you have at the bank. And typically people who have a very bad credit score that can't qualify or aren't credit trustworthy enough on their own will have to be forced in getting a secured credit card. So this is not something you want. This is something you get as your last resort in getting a credit card, is to get a secured credit card. Typically more expensive and even more demeaning. I don't suggest seeking these out unless that's your only option. Now, a big popular source of open credit are travel and entertainment cards. Um, so American Express is probably, let's say even Chase, American Express are pretty big in this T&E cards, which are called travel entertainment. So they're aimed at providing business customers with a means of paying for travel and business and entertainment for their employees. So you get a job at a big company, and then they issue a company credit card. So a company credit card is basically what this travel entertainment is. So when you travel, you put all your um, travel expenses on these credit cards and use your personal credit cards for your personal expenditures. So if you know that your company will cover the airfare, the hotel, certain meals, you put all that in your travel entertainment card. If you have to take other people out to dinner, so this way none of this comes out of your own money, it comes out of the company credit card, but you're responsible for it. So now the major difference between a travel entertainment card and a bank credit card is that the travel and entertainment cards do not offer revolving credit. They require full payment of the balance at the end of each month. That's why they're typically American Express cards, which require that. Not all American Express cards would require that, but these definitely the travel entertainment cards do. Um, now, and there's typically an annual fee but since they don't make much money on the card because the balance is paid off in full, there's typically an annual fee to cover the costs of the issuer of these credit cards. And this is typically something you're not going to get as a regular consumer, but if your company may provide them. Okay. Single purpose credit cards. These are some of the credit cards are usually easier to get. So usually your first credit card might be a gas station credit card or a Target credit card or um, a Kohl's credit card. I think that's how I got that Kohl's credit. It was one of my first credit cards I opened up. I think actually the first credit card I got was a J.C. Penney's card, which I canceled, which I should never have canceled because it didn't hurt my credit score because it was one of my oldest accounts. Um, but this is when a company issues their own credit card, um, and in this way, if they have their own credit card, they help avoid paying those merchant discounts. So if you have that Target credit card and you buy all your merchants at Target using the Target credit card, that's why they can give you a discount if you use your Target credit card, because they know they're not going to have to pay that merchant discount, and they also could make some money on the interest that's going to be charged. Um, so these single purchase credit cards, if it's a store that you purchase at frequently, these single purpose credit cards could be a good way of saving money because you typically get, for example, I know at Kohl's, they'll send it, not that I do a lot of shopping at Kohl's, but they will send out this mailer every couple of months where you get 30, 20, or 15% off your purchase. So only if you use the Kohl's credit card. So they try to encourage their shoppers to get the credit card because will make more money off the credit card than if you just shop with somebody else's credit card. And that's why they're always so pushy at the register. Oh, get an extra 20% off today if you sign up for the credit card. And a lot of people do this because if they're making a rather large purchase, oh, get our credit card, we'll take X amount of money off. This will also be something the airlines will do. You go to book an airline ticket and they'll say, oh, if you sign up for the credit card, we'll give you $200 off of this flight. So they're always trying to. It's very tempting. Typically, these are not the best offers though, especially for airlines. So if you sign up for an airline credit card and they just give you $200 off of that flight, if you sign up for the credit card outside of booking a flight, they typically give you $500 to $1,000 of credit card of travel reward points that can be used to buy future tickets. Um, but single purpose cards are pretty popular. And it's all for them to make more money, these stores. Uh, Typically, most of them have no annual fees, especially the retail stores, but the airlines do have annual fees. Traditional charge account. So the charge account is offered by a business. So for example, this goes all the way back to the beginning of time almost. Even if you've ever saw the show Little House on the Prairie, takes place in the 1860s or 70s. And they'll go into the general store and they'll put their payments on credit on the store if they don't have money to actually buy their stuff. So it's just a way of putting your charges on account at the store. Uh, Now, it's a type of open credit. It's really, I would say, not doesn't happen that much these days that businesses will open up their own lines of credit for you. It's sort of like a bar having opening up a tab for you. Today, bars won't open up a tab for you just based on your trustworthiness. They'll open up a tab only if you leave the collateral like your credit card. But typically you have to pay the bill in full, or there's additional interest and fees as well. Um, Now, here's the difficult part. There's so many choices to choose from. There's a huge amount of choices when trying to select what credit card you want. Um, so as a credit user, you want to carry um, an unpaid balance from month to month. That way, if you can't make your full payment, you'll be able to not incur any type of penalty. So you want this rotational balance. You want some sort of convenience. You can pay your credit off, balance off in full, or you could pay it off in installments, but whatever best for you. Um, so if you use the best parts of a credit card, which is the convenience of using the credit card to buy things without carrying cash around and earn extra points, but also the credit fortitude of paying your balances off in full, that could lead to a very successful financial life with credit cards. This way, you minimize the money, the extra money you pay to these companies. Now, let's talk about, and this is something that as you think about, if you don't have a credit card already, as you think about getting a credit card, you may want to think about, you know, how are you going to use it, when are you going to use it, and there are so many different credit cards and so many different reward schemes. They just came out with one recently, which I think the City Cash Card, where they have a rotational. You get 5% back, but on your biggest spend category for the month, whether it's groceries or gasoline or travel. So they always are trying to come up with something that would be good for a certain group of people. And so you just have to really figure out what credit card. And there are even apps. There is an app. I don't exactly know the name of it right now. I forgot what the name of this app is, but I remember seeing it advertised where they basically, you log in all your credit cards, and when you buy something, it'll tell you which is the best credit card to use to get the highest amount of cash back or reward points for the purchase. So, because keeping track of, I have, I myself have 15 different credit card accounts. Keeping track of all the different credit cards and which credit cards they should use in each situation is usually a little difficult. Um, and oftentimes I find it best to use one credit card to really pool all my points, so I get a big enough pile of points where it actually would, show a significant cash back or significant reward. Anyway, uh, let's go into some features that different types of credit cards that you should look at. As far as someone who's going to be using credit a lot and not paying off their balance in full, you're going to want to look for a lower APR rate. If you're a convenience consumer, you would want to look for, this is someone who's going to pay off your credit card balance in full. Look for bigger grace periods so you have a longer time before you have to pay off your credit card in full. Zero or low annual fees, and free benefits. If you're a convenience and a consumer user, you would want all of these things. Now, if you don't already have a credit card or you're thinking about getting another credit card, um, that's usually a good idea, because Um, but before you get a credit card, you definitely, as college students, you want to start building your credit history. So now is a good time to get a credit card because you're probably going to be of age. You're going to want to start building that credit. This can help with if you're away from home and you have an emergency that you have to pay for. The credit card is a good way of facilitating that. You're going to be building a credit card history. Uh, but the first step really is to apply to a credit card. And when you apply to a credit card, uh, you have to do your research. Now, in the past, before this card act was enacted, credit card companies used to prey on college students. They would come to the campus with free t-shirts, free frisbees, free food. They'd have applications. Sign up for the application, get this gift card, $20 at Starbucks. Um, that they were pushing the credit cards so hard on students to get credit cards that there was no financial education along with it. So many credit card students who got credit cards wound up having troubles, not paying off their balances, not being able to afford their balances, not telling their parents about these credit cards, and wound up graduating and destroying the credit card scores and the credit worthiness because they just really weren't equipped to deal with um, this instant cash accounts. And a lot of times, to get these credit cards as a college students, you didn't have to have a job, didn't have to have any income, you didn't have to have any credit history, but you were going to pay an annual fee or high rate of interest or high rates of fees. So in the past, credit card companies were very bad to college students. They were predatory. They gave them the worst deals, and they lured them in with really, really inexpensive gifts to get them to sign up for cards, not in their best interest. So for you, luckily that's banned. Those no longer allowed to occur on campus. You can use the internet easily to get more information about credit cards. Now, how do the companies evaluate you as a potential credit card customer? Well, it's usually what they call the 5 C's of credit, which are character, capacity, capital, collateral, and conditions. So these 5 C's, the character refers to your sense of responsibility with, how you pay off your debts. So if you established a history of repaying your debts on time, your student loans, your other type, maybe auto loans, uh, is going to exhibit or document good character. Uh, that you really take your borrowing seriously and you work hard to pay off your debts on time. Capital and capacity really kind of work together to determine your ability to repay your credit cards. And the capacity is really, what kind of income do you have? What kind of money do you have to pay off your credit cards? So if you're not really generating a lot of income, you're not going to be able to charge a lot or pay off your credit cards. It makes you riskier if you don't have the capital, which is the money or the capacity to earn money to pay off your credit card. Um, so capital is really what your financial holdings are today, and um, capacity is your ability to take some of that money to pay for your credit card. Now, collateral is looking at assets that you can secure your credit card with or secure your debts with, such as a house or a car. And conditions, which is the last of the C's, refers to any impact on your current economic environment you may have and your ability to repay your borrowing. So it's really, um, are you working? Are you graduating from school? Are you going back to school? So these are different things that they can review. In the past, banks would have to review this through a long application form and try to get an assessment of this. But today, they can more easily do this with a credit score, and that's what banks rely on these credit bureaus to gather information about you, your financial history, your payment history, and sell it to other customers. So they basically develop a file or a report on you and assign you a credit score, sort of like a grade or a GPA. And this information is what companies will use to decide whether or not to give you a credit card, how much your credit limit should be, and how much of an interest rate to give you. Um, and this is going to affect if you're going to get, if you can get a car loan, if you can get a mortgage, and what rate of interest you'll pay on them. Also, the credit loan can be used if you want to rent an apartment. They may check your credit score before they allow you to rent an apartment. So if the idea is if you have a low credit score, they're not going to rent to you because you're most likely not going to pay the rent. Uh, so this is a numerical value that's calculated using various inputs, and each of the credit agencies have a slightly different formula of how they're doing it, and then they determine the number would equate to your risk level, and customers who have the best credit rates get the lowest rates of interest. Now, things that are going to affect your credit score. So these are things that you should know more. Let me just see. Okay, so we've got some good slides coming up. Things that are going to affect your credit score. One, um, actually, your credit score is going to affect the amount of interest rate, the level of interest rate in your credit cards. The worse your credit score, the higher rate of interest they'll charge you. If you have a really great credit score, now you're someone they're going to try to compete to get as a customer, and they'll try to entice you with a lower rate of interest. The size of your credit line, the better your credit score, the bigger the credit card limit will be. This can affect your insurance rates. So when you look for life insurance, home insurance, car insurance, they're going to use your credit score as one of the factors deciding how much to charge you. Sounds crazy, right? Why should your insurance rates be a reflection of your credit score? But they use this against you. And of course, it's going to affect your mortgage rate. So if you have a low credit score, you're going to be paying thousands of dollars more a year to buy a house. Um, the stronger your credit score, the lower your rate of interest. That's why you want to protect and develop your credit score. Now, how your credit score is computed is based on a computer model. Fair Isaacs is one of the corporations. They make the FICO score, and there are like there are other divisions besides Fair Isaacs that um, will calculate your score. There are three big ones. Well, think I'm not sure their names. I'll come back to you with that later. The range for all these credit score companies go from 300 to 850 as the max, and you can visit this. Here's an interesting web link to go to estimate what your score would be, or give some information that can estimate your score. Now, typically, the distribution of scores as far as population, actually 20% of the population do reside in this 800 to 850 score. And most credit cards today, if you get a credit card, they will tell you your score. So if you have a credit card, you can go to the app and they'll have a point, or the website, and they'll have a see your credit score. You click on it and they'll show you your credit score and update it monthly. It's one of the features of having credit cards now is that they keep you abreast on what your credit card score is. And I like the one that comes with um, Capital One has these venture cards, and when you get their credit score, they will actually break down what is helping your score go up and what is making your score go down, and they'll even email you every time there's a change in your score and why it changed. So they're being a lot more open about how these scores are calculated and what's been affecting them from month to month. Most of the population is between 700 and 850, and this is generally considered pretty good credit. But there are percentages of people who are below 600, below 500, and these are the bad credit range areas. So even a good credit score doesn't mean you're necessarily guaranteed to get a loan. Uh, uh, it's not 100% of a guarantee, even though you have a good credit score. There can be other factors in play, uh, but primarily those 5 C's we talked about. However, if you do have a good credit score, it does give you a much better chance of getting a loan. And it also means you're going to pay lower interest rates on it. But for example, what I mean when I was talking about here, you could have a great credit score, but if you have no income and you apply for an auto loan or a mortgage and they see you have no income, just because you have a great credit score doesn't mean you're going to get the loan. So there's still other factors at play. But for most credit cards, if you have, I would say just about all credit cards, if you have a really good credit score, you're going to get the credit card and at a lower rate of interest. So your credit worthiness is also going to be mixed up with your employment history, um, the amount of debt you currently have, your how long you've been living in your current address. So there's other factors that go into these determinations of whether or not you're going to get a loan. So let's just look at the score. So here's a hypothetical. If you're in this excellent score as 760 to 850, you're going to get the lowest rate. And as your score goes down, your interest rate will increase and your monthly payments on your auto loan will increase. And this is why you want to be diligent and you want to maintain a high credit score, because it will save you a lot of money in the long term, because of the fact you'll be paying a lower rate of interest. So this side is the mortgage, this side is the auto loan. So you can see there's quite a difference from the top, 1400 to 1600, and for the auto loan, 700 to 860. Quite a big difference. So let's talk about what's in your credit report. So it's going to have, so if you could get a free copy of your credit report, and in it will be information that identifies who you are, the current credit card accounts you have open, inquiries, which means every time that you apply for a loan or credit card, it becomes an inquiry. Too many inquiries can reduce your credit card, your credit score. A public record and any type of collection items, anytime someone had to formally put a collection process against you using the courts or public records. So here are the factors that determine your credit score for most of the credit card divisions. The biggest factor is your payment history. This is why you never want to have a late payment. The biggest chunk of your score comes from your payment history. So always pay on time, and one way to make sure that you never miss a payment is to set up these automatic payment on your cards. The types of credit you use, and this means that they don't want all your credit to be credit cards. Sometimes as you get older, you get a car loan, that's a different type of credit, helps your credit score. You get a mortgage, a different type of credit, helps your credit score. So the different types of credit you use using a mix of credit. New credit is going to be a factor. Too much new credit is going to lower your credit score. So you want to be careful on how many. Generally, you don't want more than two new. You don't want to apply for and get more than 2 new credit cards a year. So if you can get 2 new credit cards a year every year for 10 years and have 20 credit cards, that will not lower your credit score. So the amount of credit cards you have will not lower your credit score as long as you acquire them slowly. The length of your credit history is 15% of your score. So that's why it's very important. The first credit card you open, I would try to open up a credit card that does not have an annual fee. Something that you're not going to be tempted to want to close, that you're going to keep for a long time, because this is going to affect your credit history. And it will contribute to a higher credit score all the way up to 20 years. So once you have a credit card that is an account at least 20 years, you're getting the maximum points for this length of credit history. And then the amount owed is a big part. Say you have the ability to borrow $100,000 in credit card debt. If you borrow up to $90,000 of that money, your credit score is going to go down because you've borrowed a great deal. So you want to be generally between 10 to 40% of your capacity on your credit lines that are open. So you want to owe anywhere between 10 to 40,000 if you had $100,000 worth of credit. So if you say you had a credit card with a limit of 10,000, you would want to be in the $1,000 to $4,000 range of what you have as an outstanding balance owed. Now you want to have, that's probably the range that contribute most to your score going up. So they do using your credit cards and having a balance is also good for your credit score. You just don't want to overdo it. You want to be always under 50% of your full credit limit. You don't really want to borrow more than 50% of your credit limit because it could affect your score. You can easily monitor your credit. Like I was saying, most credit cards now come with the ability to review your credit score, and in some cards even give you details of how the score went up or went down. But you can also get a copy of your credit report once a year from this website as a free copy. And And you can check that all the information is correct, all the accounts are correct. You can also get credit monitoring services. So like Fair Isaacs does, for a certain amount of money each month, they will monitor your credit for you, give you alerts, and you can get a better idea of what your credit is at any time you just log into their website. So it's probably a good idea to monitor your credit to make sure that nobody has, you know, um, fraudulently opened a credit card in your name. Now, so this is the Fair and Accurate Credit Transactions Act. So this is an act of 2003. So one, protection against identity theft. So identity theft is a real issue where someone steals your identity. They get a hold of with all this hacking going on, and all these credit card companies getting hacked and department stores getting hacked, your social security, your credit cards, your driver's license, a lot of information about you is probably flying around the dark net. So the only thing in your favor is that so much of this information is out there that no one criminal can use all of it. So it's unlikely it will be used if they did get this information. But to be on the safe side, it is good to monitor your credit, to get a copy of your credit report, so that way you can see that all the credit assigned to you is from you, that there's nobody piggybacking and opening up credit cards on your account without your knowledge. Um, so this act also helped to establish better laws and communications about who can get access to your credit card information, who they can share it with, um, you know, uh, better ability to place fraud alerts on your account or freeze your account. So this just made the protections as an individual and protecting your credit a little bit stronger, this act. Now, the Consumer Rights Act that, was also passed, take any complaints you have, um, these can be a more formalized process to protect the consumer when you complain about your credit. So as far as the credit bureau and your rights, there is this Fair and Accurate Credit Transactions, or FACT Act, and um, so this was also in 2003, which this act um, allows you to request a free copy of your credit report so you can check it out. And the three main bureaus I was talking about before, that's going to be Experian, Equifax, and TransUnion, as people who are going to be assimilating and putting your credit transactions together. So if the information in your file isn't accurate or it's missing something, you can contact these credit bureaus, and um, their contact information is, do I have it here? Yes, I have the contact information here if you want to contact these credit bureaus, and they can investigate to make sure, remove any errors on your accounts. Um, you can, it may take a while, you may have to call several times, but if they're incorrect information, they should investigate it and you should be able to have that removed off your credit report. Now, there's also this Fair Credit Reporting Act, which is another acronym, which limits the length and time damaging information can remain on your file. So bankruptcy information can remain on your file for only 10 years, and other negative information must be removed after 7 years. This is a very important. Before this act, if you had a credit-related problem, say going back, they would be on your record going back 10, 20, 30, 40 years. It would just destroy your life forever. So this was a very useful thing. They're saying, after so many years, that has to be taken off of your report and no longer be held against you. Um, so it limits access to it also limits access to your credit file to only those who have a legitimate right to view it, such as a financial institution, or anybody considering to extend you credit or employ you. They're going to be doing business with, that has a right to see your credit report. And if your credit card application is rejected, you can get more information as to why. So this Fair Credit Reporting Act, this is, I think, one of the most important features, because there are some people who just messed up in college, got into some financial trouble, and the judgment or bankruptcy resulted that just haunted them for their whole lives. It's just not fair. So I think 7 to 10 years, 7 years for credit incidences and 10 years for bankruptcy seems fair. And something you make a mistake like this shouldn't haunt you for the rest of your life. So here again, here are the phone numbers and contact information of these and websites of these companies to check your credit and fix your credit if you think something is wrong with it. Um, Now let me go back to if your credit card application is rejected. So you apply for a credit card and they say no. You have the right to find out why you were rejected. So um, you can contact the credit card company and they're supposed to give you information about why you were rejected, either the bank or the credit, which should give you a reason for why you were rejected. And this is just only fair. And you can also request a free copy of your credit report if you've been rejected to see what's on your credit. Now, there's, let's see, resolving credit or billing errors. Um, the Fair Billing Act, FCBA, there are procedures for correcting um, any type of billing errors, uh, and what to do. So they formalized the process and made a law around what do you do if there's an error in your billing. Somehow a company charged you too much. And I think we all know that we can go and complain to the bank or the credit card company that this was billed incorrectly or this was an error, and that they typically would would ask you to call the company directly, try to resolve it with them first. If you don't resolve it with them, then they're going to take actions. So they can withhold payments for the item in question. If you say you didn't buy it, you didn't charge your card, they can withhold the payment from the company. They can do a chargeback where they can actually, if they did get the money, they can bring it back from the company that charged you and put it back on your card. But so you have to notify the credit issuer within 60 days of the statement date, uh, any type of billing or billing error that you need to address on the credit card. And the notification should be within 30 days, and then the card issuer investigates within 90 days to see whether or not they're going to give you a full credit back on your account. So this is something that hopefully you never have to go through, but occasionally you might get a charge on your credit card that you shouldn't have gotten. It's a mistake. And like I said before, the first thing you should do, go to the company that charged you and ask them to issue a credit. That's the easiest and fastest way of getting it done. If they don't believe you or they don't feel it's not legitimate, then you're going to have to go to your credit card company and start a dispute. And the more information that you have, um, they will, in most cases, I say they're pretty fair, and usually more in the consumer side than the other businesses side that charge you more on your side to make sure that you get that money back, and that you know they dispute. And oftentimes, they might just charge back the company, and that company is going to have to, you know if they really feel that you got this merchandise, or you charged it and it was legitimate, they may actually go, and then they have the ability to follow up with you in other legal proceedings outside the credit card. So you should be careful this. You don't want to use this as a way to try to cheat a company, because they do have other legal recourses after this. Um, these are the major provisions of the consumer credit laws. The Truth in Lending Act is 69, which is more about explaining terms and charges to customers. And then the amended in 71, um, from prohibits lenders from sending unauthorized credit cards and limits credit liabilities to $50 for unauthorized use. So it used to be that they would just mail you a credit card, and you didn't ask for the credit card; they just open an account and send it to you. The Fair Billing Act of 75, which set up procedures for correcting billing errors and opening up new accounts. The Equal Credit Opportunity Act of 75, which helped to stamp out discrimination between Sex and marital status. This is where I was saying that women couldn't open up credit cards without a husband's permission. You know, it's just ridiculous. And then in 77, the Equal Opportunity Credit Act, which looked to prohibit discrimination against race, national origin, religion, age. And then the Fair Debit Collection Practices of 78 prohibits unfair, abusive, deceptive practices from debt collectors, which often lie or mislead people in trying to collect your debts. And the Truth in Lending Act in 1982, which requires um, installment credit contracts to be written in plain English. And basically, they used to make these credit card contracts so complicated no one could really read the fine print. And the Truth in Lending Act made it so that you had to make it a little bit more transparent. The Fair Credit Reporting, I'm sorry, the Fair Credit Reporting Reform Act of 96. This is the updated version of the Fair Credit Reporting Act of 71. We talked about a little bit about this before. The Fair and Accurate Credit Transactions Fact. We talked about this also earlier. Consumers to request one free annual credit report. The Credit Card Accountability, Responsibility, and Disclosure Card. We talked about this, which happened something that Obama pushed through in 2009 about a little bit fair, making credit card companies act in a fair rate as far as rate increases, informing the customers over the limit fees, universal default, pretty much tying up all these deceptive practices credit cards use to get more money out of their card users. And then finally, we have the Dodd-Frank Wall Street Reform Consumer Protection Act of 2010. Creates a Consumer Financial Protection Bureau, FCPB, which is the purpose of educating consumers, um, enforcing federal consumer laws, and gathering and analyzing information to help consumers. So you can see all of these acts had to be um, enacted into law through Congress and the president because credit card companies just got better and better at being tricky and getting fees and getting extra money and having you pay higher interest rates and putting you in compromising positions. So all these acts had to be created to make these credit card companies play in a more fair rate way with their consumers. And credit card companies have historically just been trying to um, make more money continuously. There was a point where in New York State they passed some laws that limited the amount of interest credit card companies could charge customers. So all these credit card companies packed their bags and moved to South Dakota, which had no such laws. And that's why if you see where your credit card company is incorporated, it's probably in the state where they don't mandate uh, a minimum or a maximum, sorry, a maximum limit the maximum credit card that a credit card can charge a consumer. Um, okay, so the Consumer Financial Protection Bureau, this is what was set up in the previous act. I think that was, not sure which act that was, but this was set up. This was in the later act, I think the 2009. Oh no, I'm sorry, the 2010. That was the Dodd-Frank Act that set up this bureau, which is a separate government entity that's going to provide a single location for financial protection oversight of the industry. So rather than the government piecemealing all these laws and new acts and amendments continuously, we have a bureau to more directly um, engage with the credit card industry and protect the consumer on a daily basis. Um, so this is going to ensure that financial markets are going to be easier to understand, make prices clearer, make comparison shopping easier. So this bureau isn't just about credit cards; it's about a lot of financial interaction between consumers in the business world, and they're sort of the government in between to make sure everything is fair as possible. So another big thing that you might be worried about that can kind of occur more frequently than not is identity theft. So identity theft is when someone uses your name, address, social security number, bank information, credit card information, and uses it for their own gain. And this is something that you can easily prevent by being a little bit more diligent, which is one, don't give your social security number out to just anybody. Yes, you have to give your social security number out to credit card companies, to banks, to financial institutions like brokerages, but you don't have to give your social security number to your dentist or your doctor, or anybody who asks for it that does not have a legitimate financial reason for using it. The Typically, you should only give your social security number out is if somebody needs to run a credit check on you because you're looking to get a mortgage, get an auto loan, rent an apartment. Those are legitimate reasons to give out your social security number. It used to be that many different businesses and even universities used to use social security number as an easy way to create an identification number for you. So when I went to university, they used my social security number as my student ID number. So it was plastered everywhere. Even at the end of the semester, they would post grades on the wall outside the classroom. It would be sorted not by name, but by social security number. So since then, one of these acts that we were talking about previously prohibited businesses and universities from doing this. So social security numbers are meant to be more private and not meant to be given to just anybody. So be protective of that number, because once they have your social security number, it's easy to fake the rest of it. So the more somebody once told me that worked for the IRS, one of the best ways to protect yourself from identity theft is to have a lockable mailbox. So you have a mailbox that is locked, so anybody can't just take your mail, because in your mail may contain a lot of sensitive information about you that it could utilize to steal your identity. Um, and likewise, just common sense stuff like shredding documents that have important information on them. I would say for most things, you should sign up for paperless options where you go to the website to download the statements. You don't have things mailed to you directly. Try to do as much paperless as possible and eliminate that paper trail. And just be careful of anybody making copies of your social security or passport or driver's license. You want to keep this um, as secretive as possible and have less people know about it as possible. So yeah, there's times when you have to give out this information, but don't always kind of think about it, question it before you give this information to limit your identity theft. Um, so it brings up the next topic. How do you know if you're a victim of identity theft? You receive credit cards in the mail that you didn't apply for. You get information of credit that was denied, or you get less favorable terms. You get notifications that your credit score went down for extra inquiries or other accounts being opened up. You receive calls from debt collectors looking to collect debts you never used, you never charged. Um, uh, you might be you fail to receive certain bills in the mail, or that's why it's another thing that can be dangerous is when you receive checks in the mail, like from your checking account. um, if those are stolen, then now somebody has your router and account number. So I would say paying by check is also is a way of getting your identity theft too, because now they have your address, your name, your bank account, and your bank's routing number all printed on the check in plain numbers. So you want to prevent that stuff. Other ways to prevent identity theft: make sure you have a safe place at home to keep a detailed list of all your credit and debit cards and all the accounts, including the 24-hour customer service number. Now, this will come in very handy if you lose your wallet. So you want to have pictures, um, maybe have some sort of your account numbers written down or pictures of your cards. What I do is I just take a picture of the front and back of my cards. That way I have all the information, the credit card numbers and the phone numbers to call in case my wallet is stolen or lost. I can easily call up and cancel or put a freeze on these accounts. Um, don't carry your social security card with you. Um, don't carry documents with your social security number on them. Don't write down your PINs, your passwords, or your access codes on your bank cards. Keep your birth certificate, your passport, and social security card in a fireproof strong box in your home or in a safety deposit box, so that way you won't lose this information easily. If you lose your driver's license, um, you're going to need these other forms of identification to get that driver's license back. And make sure you consistently check your credit reports and monitor your activities, or even better yet, sign up to a subscription to monitor your credit and give you updates of your credit. Um, And then if your identity is stolen, you want to put a fraud alert on your credit files. You want to close your accounts that have been tampered with. You want to report this to the police department. You want to report it to FTC. Um, Now let's talk about controlling and managing your credit cards and your open credit. So when you have different loans and credit cards, you want to make sure that, and soon you may also have big student loans to pay as well once you graduate. So you want to think of ways to reduce your balance. Being able to pay your debts off in a timely and consistent manner. You want to protect yourself against any type of fraud. Um, you see any signs of unusual spending on your credit cards, you want to track that down right away. Call the merchants, call the credit card companies, find out who charged this, report it. I remember I took a trip to Canada once, and I used my credit card at a couple of restaurants, and then not long after, I see concert tickets in Canada being charged to my credit account. I called up my credit card company and they were able to verify, okay, yeah, you didn't leave the country. You weren't there at this time. This is obviously fraudulent. And they tracked it down. They returned the money to me. So that's why the sooner you can do it, the easier it is for them to stop the transactions or deny the goods. Um, and make sure that, if you can't pay your credit card bills on time, you should contact your company, the direct card companies, let them know what's happening. Maybe there's something they could do. They can extend, or, just be open and honest about what's happening and seek help. Now, as far as eliminating credit card debt, um, if you look at, your annual credit card interest rate, and then this is the percentage of your initial balance. So if you only pay 4% of your balance, it could take quite a while to pay off the card. So I would recommend, if you do have an extended outstanding balance in your credit card that's getting out of control, stop putting any new charges on your card. Try to pay 15% of your card back um, each month, and you'll be able to pay that back within 7 months if you can. Or if you're doing just 10% of the balance, you should be able to pay that back off in uh, almost a year, 10 or 11 months. Now, so it does take a long time to eliminate credit card debt, but here are um, some steps that you can do to reduce or eliminate your credit card. Um, One, you want to really, you know, try to eliminate any new charges on your credit cards. The This will prevent the balances from increasing. Then step one, you want to find out, you know, how much of your initial balance can you pay off each month? And then you want to, work. Step two, you want to, start paying the higher interest cards back first, then the lower interest cards. So you pay back whatever charging you the most interest. And then, as you go through, you'll be able to, calculate a window of how long it will take to pay off these cards, if that's your goal. And you just have to always be very diligent, and understanding how long it will take to pay off your cards will give you a better idea how to budget and a goal to achieve. So you never want to go into this not knowing. So always do the math and do the work to find out how long it will take and how much money you can put towards. In some cases, if you have to get a side hustle or extra job or work more hours, it's well worth it to get out of this credit card hole. So here's a credit card habits checklist that you can look at here. As far as um, if you answer yes to any of these questions, you may have a problem controlling your credit card spending. So take a look at this list and see if there's anything here that you answer yes to. This might be an indication that you have to reassess your usage of credit cards. Okay, and remember that if you, in the future, when you have a significant other or you're going to get married, spending irresponsibly on your credit card can be a major argument in a relationship, a major relationship ender. So always communicate about your debts. Don't save it to when the honeymoon ends and announce that you have $40,000 of credit card debt. That's not fair. Make sure that you talk about this often and early. Um, So let's take a quick summary. I know this is one of the longer lectures, this hour and a half, but we talked about the different types of credit and credit accounts. We talked about the cost of opening up credit cards, specifically interest rates, annual fees, penalties. We talked about the choices of credit lines, the different types of credit cards and charge accounts. We talked about how lenders look at you and the 5 C's of your credit worthiness. We talked about different credit card charges and rates of interest. We'll talk more about effective rates of interest and annual rates of interest in the next chapter. And we also focused on how you can control your credit card spending and look for signs of trouble. Okay, that's it for this lecture. I hope you enjoyed this chapter, and we'll talk to you soon. Take care.